If you own a home in California or you're about to buy one, the conversation around insurance has changed a lot in the last few years. Premiums are up, carriers have pulled back from certain areas, condo owners are getting hit with surprise assessments, and a lot of buyers are finding out at the worst possible moment that the insurance situation they thought was on their property isn't what they thought it was. So in this video, I'm going to walk you through how homeowners insurance actually works here in California. We'll talk about what it is, what it covers, the difference between private insurance and the California Fair Plan, how a single family policy differs from a condo policy, what's going on with HOA master policies right now, and some practical ways to save money on insurance without leaving yourself exposed. And real quick, if this is your first time here, my name is Jed Bratt. I'm a California real estate broker serving San Diego and Riverside counties, and my partner Jamili and I have helped hundreds of people just like you buy and sell real estate in California. If you're looking for assistance with buying or selling and think we'd be a good fit, feel free to get in touch. My contact information is below. So at its most basic level, homeowners insurance is a contract between you and an insurance company where you pay a premium and in exchange, they agree to cover certain losses to your home and belongings and protect you financially if someone gets hurt on your property. Now, in a standard policy on a single family home, it's what we call an HO-3 policy, and it has 5 main coverage parts you'll see listed on the declarations page. Coverage A is the dwelling itself, your home's structure. Coverage B is the other structures on the property, like a detached garage or a shed. And coverage C is your personal property, your furniture, electronics, clothes, jewelry, guns, all the stuff inside your home. Coverage D is loss of use, which pays for things like a hotel and meals if your home becomes unlivable due to a covered loss. And coverage E is personal liability, which protects you if someone gets injured on your property and sues, or if you accidentally cause damage to someone else's property. Now, the reason this matters is that when you're shopping for a policy, the price isn't really the first thing to look at. The first thing to look at is whether these coverage amounts actually match what your home would cost to rebuild today, and whether your liability limit is high enough to actually protect your assets. Let me give you a few examples. Let's say you bought your house 10 years ago for $500,000. And today that same house might cost $700,000 or $800,000 to rebuild, especially after the cost of material and labor have gone up so much in recent years. If your dwelling coverage is still set at the old number and a fire takes the house down to the foundation, you could be hundreds of thousands of dollars short on the rebuild. So the dwelling limit needs to reflect the replacement cost, not market value, and not the price you paid. For context, according to data from insure.com pulled in 2026, the average annual cost of homeowners insurance in California has been hovering somewhere around $1,400 to $1,900, depending on the source, the coverage, the amount, and the location. But in higher risk areas, especially in or near wildfire zones, premiums can run multiple times that. And that's assuming you can find a private carrier willing to write you at all. Which brings us to the next piece. What happens when private insurance companies won't cover you? That California Fair Plan comes in. So the FAIR Plan stands for Fair Access to Insurance Requirements. It was created back in 1968, and it's basically the state's insurer of last resort. It's not a government agency. It's a private association that all admitted insurers in California are required to participate in. Now, the way it works is that when you've been turned down by the standard market, usually because you're in a high wildfire risk area or have some other underwriting issue, the FAIR Plan is required to provide you with basic fire coverage so that you can at least satisfy your mortgage lender's requirements. Here's the key thing about the FAIR Plan. By default, it only covers fire and smoke. That's it. No liability, theft, water damage, personal injury, none of the stuff a normal homeowner's policy includes. So if you end up with a FAIR Plan, what most people do is they pair it with what's called a difference in conditions. And the DIC wraps around the FAIR Plan and fills in all those other coverages, so you essentially end up with something that resembles a comprehensive homeowner's policy. You're paying 2 premiums for a combined level of protection, but it's how the system works right now for properties that the standard market won't touch. And on coverage limits, the FAIR Plan currently caps residential dwellings at around $3 million per location. They also recently expanded their commercial coverage to around $20 million per building with $100 million aggregate per location, which was a big update and aimed at helping HOAs and larger developments that have been struggling to get coverage. We'll come back to that in a minute when we talk about condos. One more thing about the FAIR Plan. It's expensive and it's getting more expensive. The FAIR Plan filed for an average rate increase of around 35% for 2026. So if you can find a way back into the standard market through home hardening, defensible space, or just shopping more carriers with an insurance broker, for example, that's almost always going to be a better long-term move than staying on the FAIR plan indefinitely. Now, let's talk about condos because the situation there is its own animal, and it's where I'm seeing a lot of confusion and some real surprises for both buyers and current owners. When you own a condo, you've got two layers of insurance in play. There's the HOA master policy, which covers the building structure and common areas. And then you've got your individual unit owner's policy, which is called an HO-6. Now, the way the two interact is determined by your CC&Rs, covenants, conditions, and restrictions, and the type of master policy your HOA carries. There are basically three types of master policies. The first is called bare walls, which means HOA's policy covers the building structure, the studs, the framing, the roof, the exterior, but everything from the drywall in is your responsibility. So the cabinets, flooring, fixtures, appliances, all of that has to be covered by your own HO-6 policy. The second type is what's called single entity, which extends the master policy a bit further to include the original interior for fixtures, but typically not for any upgrades or improvements you've made. And then the third is called an all-in, sometimes called an all-inclusive, which is the most comprehensive. It covers the building, the interior, and sometimes even owner improvements. Most condo associations carry one of the first two. So if you're a condo owner or buyer looking through your HOA documents, the first thing you should do is find out which type of master policy your HOA has, because that directly determines how much coverage you need on your own HO-6 policy. Now, in addition to property coverage, California law actually requires HOAs to carry several other policies. Under the Davis-Sterling Act, an HOA needs to carry general liability insurance, at least $2 million for associations with 100 or fewer units, and at least $3 million for those with more than 100. They also need directors and officers insurance, which protects board members from personal liability for decisions they make in the official capacity. And they need a fidelity bond, which is called crime coverage, which protects the association from theft or fraud involving HOA funds. So the master policy isn't just one policy. It's really a package of coverages that the association is legally required to maintain. So here's where things have gotten really difficult for condo owners over the last couple of years. Across California, and this is hitting Southern California especially hard, HOA master policies have been getting non-renewed or hit with massive premium increases. There's been one widely reported case of a condo community in Mira Mesa where a master policy went from $47,000 a year for $50 million in coverage to $600,000 a year for only $10 million in coverage. So 13 times the premium for 1/5 the coverage. I just saw one in Tierra Santa where the premium went up 800% in a year. And that's an extreme example, but the broader trend is real. Many associations are getting non-renewed by their insurer and being forced into the surplus lines market. These are not admitted carriers, places like Lloyd's of London, where rates often run 20 to 30% above standard market rates. Deductibles on master policies have been climbing too. It used to be common to see a 5% deductible, and now we're seeing 10% or even higher in some cases. Now, what does that mean for individual condo owners? It means three things. First, your HOA dues are very likely going up to cover the higher premium. Second, you might get hit with a special assessment to cover a sudden increase or a master policy deductible after a loss. And third, and this is really the one I want you to really pay attention to, many associations are amending their CC&Rs to shift some of that fire insurance responsibility from the master policy onto individual unit owners, which is actually a good thing in some cases. So you might get a notice from your HOA saying that going forward, you as an individual owner are now required to carry fire insurance on your unit. That's a big change. And depending on where the condo is located, especially in higher fire risk zones, in areas like Tierra Santa, Scripps Ranch, parts of East County, or up in the hills, you might find that you can't get the fire coverage from the standard market either, which means you end up on the FAIR plan plus a DIC wrap just for your individual unit. For example, the CC&Rs might say the HOA must carry full replacement cost coverage on the buildings, but if their master policy now only covers $10 million on a complex that would actually cost $40 million to rebuild, they're technically out of compliance with their own governing documents. And that creates a problem for unit owners because lenders are increasingly hesitant or outright unable to approve loans on condos in associations that don't have adequate master coverage. Which means if you go to sell your unit, your buyers might have a harder time or not even be able to get financing, and that affects what your condo is worth. So if you're a current condo owner, my advice is request a copy of the master policy and the most recent insurance certificates from your HOA. Look at the deductible, look at the coverage amount, and compare it with what your CC&Rs actually require. And if you're a buyer looking into condos right now, this is something to dig into during your due diligence period, not after you close. The default amount on most HO-6 policies is something tiny like $1,000. In today's environment where assessments can easily run 5 figures per unit, you probably want to bump that up significantly. A lot of brokers are now recommending $50,000 or more in loss assessment coverage. It's usually a pretty cheap endorsement to add, and it can save you from a really painful out-of-pocket expense down the road. All right, now let's talk about deductibles for a minute, because this is where a lot of people accidentally overpay or underprotect themselves. Your deductible, if you don't know what it is the amount you pay out of pocket before insurance kicks in. Common options are $500, $1,000, $2,500, or $5,000. Some policies have separate deductibles for things like wildfire or wind, often expressed as a percentage of your dwelling coverage. So a 1% wildfire deductible on a $700,000 dwelling would be $7,000 out of pocket. And the general rule on deductibles is to set them as high as you can comfortably afford to absorb out of savings if you had to. The reason is that for small claims under a few $1,000s, you're usually better off just paying out of your own pocket and not filing the claim, because filing claims can affect your premiums and even your insurability going forward, just like car insurance. So if you wouldn't file a claim for under $4,000 anyway, having a $500 deductible doesn't really do anything for you. It just costs you more on the premium every year for a benefit you wouldn't actually use. Okay, so let's talk more about how to actually save money on your insurance. There are a few practical things that move the needle. First, shop the market. And I don't mean once when you buy the home and then never again. I mean every couple of years. Carriers come in and out of the market, their pricing changes, your situation changes, and what was the best deal 3 years ago might not be today. Second, raise your deductible to a level that matches your actual claim behavior. Like I just mentioned, if you've never filed a claim under $3,000 or $4,000, a higher deductible saves your premium without really increasing your risk in a practical way. Third, bundle policies if it makes sense. Bundling your home and auto with the same carrier often gets you a meaningful discount, somewhere in the 10 to 25% range, depending on the company. Fourth, harden your home. If you're in or near a wildfire risk area, things like Class A roof, ember-resistant vents, defensible space around the structures, and removing combustible materials within 5 feet of your home can qualify you for discounts under California's Safer from Wildfires program. The state has been pushing carriers to actually price these mitigation efforts into their rates, so it's worth asking your agent about those specifically. Fifth, don't overinsure your personal property. Most policies default to personal property coverage to a percent of your dwelling coverage, typically 50 to 70%. For a lot of people, especially folks who don't have a whole lot of high-value belongings, that default is more than they actually need. You can sometimes adjust it down and save some premium. And sixth, be careful about filing small claims. Every claim goes onto what's called a clue report, which insurers use to evaluate you. Filing 2 claims within a few years can raise your premium meaningfully, or in some cases, you get non-renewed entirely. So save your insurance for the bigger losses and self-insure the smaller stuff if you can. Now, one more topic before we wrap up: going direct to an insurance company versus working with a broker. When you work direct with a carrier, think State Farm, Allstate, Farmers, you're working with what's called a captive agent. That means they only sell that one company's policies. The upside is that they tend to know that one carrier's products inside and out. The downside is that if the carrier's rates aren't competitive for your situation, or if they decide to stop writing in your area, you're starting from scratch. A broker, on the other hand, sometimes called an independent agent, is appointed with multiple carriers, and they can shop around for your policy across all of them. The clear upside here is choice. They can compare a bunch of options and often find a better price or better coverage for your specific situation. They're also more flexible if your situation is complicated. For example, if you're in a high fire hazard zone, or if you have a high value home, or if you need a fair plan plus DIC setup. The downside is that not every broker is great. Some are just running through the easiest carriers and not really shopping you thoroughly. For most people, especially in California right now, where the market is so unstable, I'd lean toward working with a good independent broker. Just make sure they're actually shopping multiple carriers, not just defaulting to whatever's easiest. Ask them about how many carriers they pulled quotes from. Ask them if they can quote a fair plan and DIC combination if your area might require it. A good broker will have answers to those questions immediately. So let me bring this all together. If you own a single family home, your priorities are making sure your dwelling coverage actually reflects the current rebuild costs, your liability limit is enough to protect your assets, and you're shopping the market every couple of years. If you're in a fire zone or near one, expect higher premiums, look into home hardening for discounts, and explore the standard market and the Fair Plan Plus DIC route. If you own a condo, the most important thing is to know what type of master insurance policy your HOA carries, request a certificate of insurance and meeting minutes annually. Make sure your HO-6 has solid loss assessment. I'd recommend at least $50,000. And stay aware of any CC&R changes that might shift insurance responsibility back onto you. Generally, they're going to require a vote if they change the CC&Rs, but something to be aware of nonetheless if you're not paying attention. And if you're looking to buy a condo, especially any areas with elevated fire risk, make sure to dig into the HOA's insurance situation during your contingency period. Ask for the master policy, ideally as soon in the transaction as possible, if not even before submitting an offer. And ask for recent meeting minutes, find out how many special assessments have been issued or if any are being discussed, or even if they've had any recent insurance claims which could affect their current insurance situation. This is the kind of thing that can completely change your monthly carrying costs after you close, and it's 100% something we look at carefully when I'm helping clients evaluate condo purchases. If you've got questions about a specific property you're considering, or if you want help thinking through your insurance setup as part of a bigger real estate decision, my contact information is right down below. And you can book a quick call or Zoom at the link, or just shoot me a text. And just a side note, if you are looking for insurance brokers that you can trust, I have some great recommendations. Feel free to reach out. Just shoot me a text, let me know what you're looking for, and I'll send them over your way. Always happy to help. I'll see you in the next video.